is South Africa ready to reimagine the SDGs as more than a global obligation? In other words, the SDGs as a value proposition worthy of investment by all holders of capital, not just sovereign, as it were. To my immediate left, Mr. Rob Levinson, Head of Responsible Investing at Old Mutual. And to my extreme left, Mr. Shanail Suka, MD and founder of Suka and Associates. And online, Ms. Shamila Ibrahim, Chief Sustainability Officer at the JSE, as well as Mr. Leslie Ndawana, Principal Executive Officer of the National Fund for Municipal Workers. In fact, I just saw last night that sustainable bond issuance globally crossed the $1 trillion mark in 2021, driven by green, social, and sustainability bonds, and is expected to reach anything between 1.5 to 1.7 trillion in 2022. So the opportunity is there and quite massive. And so perhaps to just get into how have asset managers and companies prepared to receive increased global flows relating to SDGs in emerging countries?
Thank you so much, Mr. Chair, and good day to everybody. Firstly, congratulations to Old Mutual on your announcement today of signing up to the Net Zero Asset Managers Initiative. It's always so encouraging to see that this kind of commitment is being made, even in the face of some obvious challenges that we face on our own decarbonization trajectory as a country. So, Mr. Chair, when I was considering the question that you're asking, it's very difficult at the granular level to understand how companies are preparing to receive this. But what we're certainly seeing at a high level is that the awareness is growing, but certainly not growing fast enough. And one of the objectives that you set out on the panel was looking at re-engaging with the SDGs as a financial opportunity rather than a shared obligation. And I think what we could do there is perhaps change that a little bit. And let's talk about that as really looking at this more as risk rather than saying obligation versus financial opportunity. And clearly financial opportunity will be very important to be able to spur those investment flows. But how about looking at the flip side in a slightly different angle, which is really about the risk and about considering how to reorientate those capital flows considering this. And by what do I mean? Let us take the pandemic that we are living through right now. The amount of stimulus that we've seen in the global economy has been unprecedented. On the back of this, indeed, it has put many countries into debt. That in itself is unsustainable. But what it has also done is shown us the huge inequalities that exist globally, and a lot of that money had to be poured into dealing with these inequalities. These inequalities are in fact manifested in what we call the SDGs. They're clearly looking at exactly dealing with those issues. So we have now directly seen the risks that it poses and what we needed to actually spend to be able to get ourselves out of some of this. And of course, if we look at the encroachment of nature, if we look at sanitary boundaries and the like, it has now been quite well known that we can expect more and more of these sorts of diseases to start taking root in the future. And then how do we respond? And so we're seeing the social context and the environmental context come together quite closely. And the SDGs, which we've now had, as our best collective global plan for a number of years, really being the thing we need to focus on to try to put ourselves in a position that is actually going to mitigate that risk the best way that we possibly can. So for me, that would be the first one. But why don't we see it like this? Should it not be obvious? I think the biggest issue is that we're not pricing for externalities the way that we should be. So while up to now we've been very good at internalizing profit, we've been externalizing cost. And that is where we're seeing a lot of the issues coming into play. So when we're even considering these returns that we're chasing right now, how real are those returns if they haven't adequately priced in cost? And so what should we be looking at? And there is where I think the real opportunity lies in using those SDGs and framing our thinking and to be able to look at the flip side of it to reorientate capital flows, because it's been very clear now with the evidence as to what those risks are and how they actually pose financial risk. So if we bring together the opportunity and the risk, I think we have a far better formula to be able to reorientate those capital flows and prepare ourselves for this.
Given this skew towards global funding, how do you see listed entities contributing differently to SDGs than unlisted ones?
So the first comment I wish to make, and this has been a point which has been raised by our chair, Trevor Manuel, and it's really that disparity is not just a word, but in terms of actual flows and numbers, we are able to indicate. You mentioned the amount of capital that's currently being employed in the green economy, green finance. We're not seeing enough of that in the global south. That's number one. We're not getting a fair share of the opportunities that exist in that space for various reasons. So that's to talk to that specific point. In the listed equity markets, though, it's a little bit different. And how do we actually align ourselves to this idea of return on investment being more than an interplay between risk and reward, but adding the third dimension of impact? And what we see, certainly from our perspective at Old Mutual Investment Group, is that where our presence lies, where we are able to really show up in the market, is in stewarding our clients' listed assets in a manner that achieves an impactful outcome linked to a specific SDG. And in every single company that we have invested in, there's a different SDG outcome that we can look to achieve. Every single company has the ability to do something and has the ability to make that change happen. And therefore, when we talk to specific topics, we say, what goal do you want to achieve? And that is where the SDGs is the North Star for us. We can align specifically to one SDG or a multitude. Each company is different. It doesn't mean that there isn't the ability to make that difference happen.
Industry, the retirement fund industry, and ask Chanel, what's your perspective, what's your take, given that the industry relies on return and has become accustomed to the notion of return as the key driver.
Yes, thank you, and good morning, everyone. So, there is a perception that there's some kind of return sacrifice if you investing for impact or taking ESG seriously. Based on our experience, we found that that's not the case. We've publicly shared a track record of our alternative investments that we've made since 2015, and we have shown that compared to a listed benchmark, these alternative assets have actually outperformed. And this has been since 2015, so it's not a short track record. We firmly believe as a company that directing capital to fighting climate change and addressing and mitigating unemployment and inequality is consistent with fiduciary duty. We feel that we are helping to future-proof our clients' portfolios and to help manage and mitigate their long-term risks. And finally, I actually feel that, in our opinion, this is consistent with our regulatory obligations if you look at the preamble of Regulation 28.
Yeah, and with that, I'd like to go to Leslie and ask Leslie from an institutional investor point of view, what do you see as the role of that sector in contributing to SDGs?
I think it is important for institutional investors to understand that they are catalysts for growth and development, and to acknowledge that we live and operate in a world where people require services. That cannot be the responsibility of government alone. So if we look at pension funds specifically as part of the broader institutional investors, I would consider pension funds to be DFI that must support and finance development. So I think they are, in terms of implementing impact investing, there are two important fundamentals, which is the intention and the purpose vis-a-vis action and execution. So I've come up with a model here that categorizes pension funds in relation to how they participate in impact investment. So you see that how that will help us to get into the execution and operationalizing the concepts.
All right. Let me just hand over to the panelists to pick up on that point of, action versus rhetoric. What should we be seeing more and more of, as it were? I don't know if
Sure.
Chanel.
Yes, I'm happy to take that one. So I think I'll keep things practical just to try and inspire some of the retirement fund trustees out there. One of our clients has set a job creation and a just transition as two key initiatives within their responsible investing policy. And these aren't just fancy words. They've actually set a strategy to implement this and actually dedicated assets towards those objectives. So for example, the fund has seeded 3 blended finance funds, which are impact funds that explicitly target job creation but also seek commercial returns. So far, those funds have actually generated close to 20,000 jobs. And just to put that into context, that's probably around 20% of the total direct jobs in the coal sector. So yes, we're not creating jobs in Mpumalanga or perhaps for coal miners in particular, but at least the fund is playing a part in enabling a just transition over time and creating jobs and job opportunities. In terms of a just transition, the retirement fund has already invested in the green economy and in renewable energy, and they've actively stated in their policy that as more green economy investments and opportunities come up, they will then step up their investment in funds that not only seek a commercial return but actively address the S. So in this way, as we invest more in the green economy, we also invest in the social part. We must, as a country, especially South Africa, we have to address the E and the S together. We firmly believe that now that South Africa has set net zero by 2050 as a target, that in our article we mentioned perhaps we need to set social transition targets at the same time of zero poverty, low unemployment, low inequality by 2050 as well. And it's critical that we actually address the two together. By 2050, not only will we be able to achieve our just transition target, but also perhaps we could even be the first African country to reach developed market status if we all as stakeholders work together.
What I see happening if we do nothing at this point and we just rely on the current benchmarks and just chug along at this pace without really making a fundamental change, is that market's going to be left further and further behind. It's actually going to put at risk investment into the South African economy and into the listed space by having a benchmark that is totally out of kilter and out of whack with the way the rest of the world is going. Now, we don't have to go down that route. We need to co-create something that makes sense, that is investable, that people will say, okay, you know what, I've aligned, our clients have aligned previous to one benchmark. Now they see this as an acceptable benchmark in which Sibonisa and his team have to outperform according to that. And maybe it is a set in a percentage on carbon or a South African determined low carbon benchmark, but why not include a social criteria into that thinking?
So firstly, we're absolutely open to working on that and co-creating those kinds of benchmarks that would be relevant for the economy. So the other thing that I think that the exchange can do, the benchmarks is clearly one of them. There's an element of data underneath that, but there's an element of guidance as well. And there's a few areas in which we've already stepped into that space of trying to help create that enabling environment and create the instruments that could help with this reallocation of capital, also with an impact lens. If you look at what the exchange has done, in 2017, we went live with the green bond segment. A statistic was mentioned earlier on about the global green bond segment, and green bonds actually, or kind of thematic bonds, exceeding the $1 trillion mark. In fact, South Africa, or the listed space, passed the $1 billion mark, and that was in the collection of social, sustainable, and green bonds listed on the JSE. So yes, a tiny fraction and a drop in the ocean compared to the global numbers, but certainly I think something to sit up and take notice of. So we had the segment created in 2017, which is green bonds, and those have continued to grow. And then in 2020 expanded that to include social bonds and sustainability bonds. Now, taking back to our SDG type of question, these already enable the listing or the raising of capital with this use of proceeds model that are directed to very specific end users' activities or assets that are aligned with social, sustainable, and green bond definitions. And so that already has there, and it is placed, and the JSE took the leap of faith to be able to create that. And because it's in listed environment, of course, it helps for pension funds and the like to be able to invest in that. So we've tried to create those instruments. Soon to come, hopefully within the next few weeks, will be our transition bonds and our sustainability linked bonds. So the transition bonds, of course, in the context of just transition, clearly very important instrument. And then the sustainability linked bonds, I think, are probably the closest to the impact debate, because it allows you to directly look at achieving sustainability outcomes, and you can use the SDGs as a framework, for example, and link that to the cost of capital. So you can directly say, if you achieve these objectives you set out for yourself and link those to the cost of capital, you actually can possibly benefit on the upside of reduced cost of capital for meeting objectives that can be directly linked to impact. In December last year, we actually put out for public commentary our sustainability disclosure guidance, as well as our climate change disclosure guidance. If you look at those, the approach we've taken is a principled basis. So across the market, you're really trying to get all issuers up the curve in being able to understand sustainability context. And then we have a set of metrics which directly link to very clear outcomes of why those metrics matter. And that we are hoping is a step in the right direction of moving from a tick box ESG approach towards a more impact and outcome driven approach. So we encourage everybody to please have a look at those. Public commentary closes on the 28th of February, and we would really welcome your input on that.
Yeah, look, there's a few issues. I do think we need greater collaboration, which was mentioned already. But I also feel you need more holistic risk management practices and thinking at the retirement fund level. Because, addressing ESG risks is not about sacrificing return. It's just it makes pure risk management sense to do so. Our clients are all long-term investors, and they will bear all of these risks when they materialize. If we don't address climate change, that will amplify our social risks in South Africa, and the members of these funds will retire in a wasteland, as the FSCA puts it.
Talking about the opportunities that exist in shifting to the green economy. Now, what do we mean by the green economy? We mean low carbon, resource efficient, and socially inclusive. That's our definition. And that's the definition that we use when we think about, well, this is a company that it is here now. How does it shift, take care of its workforce, not just shut down operations and decide, that's it, I'm done, and leave us with a big social mess. That's not the intentionality that we go into to drive an impactful outcome with these companies. Yes, it's to shift. Yes, it's to decarbonize. We've seen companies make a conscious effort. SAS on one hand, Exara maybe another good example of those that are most exposed to the specific risk of a transition effectively. And what they have done is this. Some have said, well, we can't change our model. We will make sure that our dirty assets, if you want to call them that, are responsibly managed towards a specific outcome into the future, and pay a decent dividend out on that front. That's the one hand they could say. On the other hand, they've said, well, there's an opportunity for us because we have a renewable energy business, or we see a real opportunity in creating and have the means, the scale, and the capacity to really change product focus and actually shift to the production, for example, of green hydrogen. So then all of a sudden this becomes much more interesting, because the investment case, the opportunity set, and the ability to realize future cash flows and revenue from a green economic outcome and an impactful outcome, retraining your staff, working with your stakeholders, looking at new projects, looking at plugging in renewable energy into your operations, your supply chain, your effectiveness, all of that becomes very exciting and very impactful, creates jobs, strengthen the existing backbone, and strengthen regulation and policy around that.
If you don't believe in it, you're not going to do it. You're going to be half-hearted about it. COVID has brought the best of times and the worst of times. The best of times is that it has forced us to think long-term as money allocators. It has taught us that if we don't do the right things, make the right decisions today, the likelihood is that we'll be out of business tomorrow.
I think it's really important that we have conversations around net zero benchmarks. As much as we're setting very clear climate targets with clear dates, can we do the same around social targets and have the same kind of conviction? So thank you. Thank you very much, all of you, for your great insights. Thank you again, and please do keep well and stay safe.